Hedge funds introduces hedge funds as a major category of alternative investments within the program. Hedge funds are private pooled investment vehicles generally available only to qualified or accredited investors. Unlike mutual funds and exchange-traded funds, hedge funds operate with fewer regulatory constraints and greater flexibility in investment strategy selection. Managers pursue a wide range of approaches involving long and short positions, derivatives, leverage, and opportunistic trading strategies. Hedge funds are designed primarily to generate absolute returns rather than simply outperform market benchmarks. Their return drivers often include market inefficiencies, volatility, and manager skill. Because of their complexity, hedge funds typically involve higher fees, lower transparency, and greater operational risk than traditional investments. A defining characteristic of hedge funds is their extensive use of leverage, derivatives, and short selling. Managers may borrow capital or use derivatives to magnify exposure to targeted opportunities, thereby increasing potential returns. Hedge funds also frequently establish short positions to profit from anticipated declines in security prices or to hedge market exposure. These tools allow hedge funds to pursue sophisticated investment strategies regardless of overall market direction. However, leverage and derivatives significantly increase financial risk because losses may also be amplified during adverse market conditions. Short selling introduces additional risks such as unlimited theoretical losses and short squeezes. As a result, hedge fund investing requires substantial expertise in risk management, portfolio construction, and liquidity monitoring. The topic categorizes hedge fund strategies into several major groups, beginning with equity hedge strategies. Equity hedge funds take long and short positions in stocks and equity derivatives to exploit perceived pricing inefficiencies. Market-neutral strategies attempt to eliminate broad market exposure by balancing long and short positions. Fundamental growth and value strategies focus on identifying undervalued or overvalued companies based on financial analysis. Long/short equity strategies seek to profit from relative performance differences between securities. Short bias funds primarily maintain short exposure in anticipation of market declines. These approaches allow managers to pursue returns from security selection and relative pricing opportunities while attempting to reduce dependence on overall market direction and traditional equity beta exposure. Event-driven strategies represent another important hedge fund category. These strategies seek to profit from corporate transactions or significant business events that may temporarily distort security prices. Merger arbitrage funds attempt to capture pricing spreads between acquisition announcements and transaction completion. Distressed or restructuring funds invest in financially troubled companies expecting recovery or restructuring gains. Activist hedge funds purchase substantial ownership stakes and influence company management to create shareholder value through operational or strategic changes. Special situations funds focus on unique corporate events such as spin-offs, share repurchases, or capital restructurings. Event-driven investing often requires detailed legal, financial, and operational analysis because returns depend heavily on transaction outcomes, timing, and evolving market expectations surrounding corporate events. Relative value strategies seek profits from pricing anomalies among related securities. Managers attempt to identify temporary mispricings while minimizing exposure to broader market movements. Convertible bond arbitrage, fixed income arbitrage, and volatility arbitrage are common examples. These strategies often rely heavily on leverage because pricing discrepancies may be relatively small in magnitude. Opportunistic hedge fund strategies include global macro investing and managed futures. Macro managers make investment decisions based on broad economic trends, interest rates, currencies, inflation, and geopolitical developments. Managed futures funds trade futures contracts across asset classes using systematic or discretionary approaches. These strategies may perform particularly well during periods of heightened volatility or major macroeconomic transitions that create strong directional market movements. Hedge funds can also be structured using different investment vehicles. A common structure is the commingled fund, where investor capital is pooled into a master feeder arrangement managed centrally by the fund manager. Alternatively, institutional investors may use separately managed accounts, which allow customization of investment guidelines, risk limits, and liquidity requirements. Another structure is the fund of funds, which invests in multiple hedge funds to achieve diversification across managers and strategies. Fund of funds provide expertise in manager selection and may grant access to otherwise unavailable funds. However, they also introduce an additional layer of fees that reduces net investor returns. Investors must therefore carefully evaluate whether diversification benefits justify the added cost burden. The program also discusses hedge fund performance and sources of return. Hedge fund returns typically consist of market beta, strategy beta, and manager alpha. Market beta reflects exposure to broad financial markets, while strategy beta arises from systematic exposure to specific hedge fund strategies. Alpha represents excess return attributable to manager skill, security selection, timing ability, or exploitation of inefficiencies. Hedge funds frequently use leverage to magnify both alpha and strategy beta. However, performance measurement can be distorted by several biases. Selection bias occurs when poorly performing funds stop reporting results, while survivorship bias arises because failed funds disappear from databases. Backfill bias may overstate returns when successful funds add historical performance only after establishing favorable track records. Overall, topic demonstrates that hedge funds are sophisticated investment vehicles designed to pursue absolute returns through flexible and actively managed strategies. Their use of leverage, derivatives, short selling, and specialized trading techniques distinguishes them from traditional investment funds. Hedge funds may provide diversification benefits and attractive risk-adjusted returns when incorporated appropriately into institutional portfolios. However, they also involve substantial complexity, illiquidity, high fees, operational risk, and reduced transparency. Successful hedge fund investing therefore requires rigorous due diligence regarding strategy design, risk controls, manager capability, and operational infrastructure. For CFA candidates, understanding hedge fund structures, strategies, and performance drivers is essential because hedge funds remain an important and evolving component of the global alternative investment industry.